helped nearly 200 brand new real estate investors research rental property markets across the country in the past 5 years. And I can tell you, there are 3 criteria that if you don't get right from the get-go, you'll have a heck of a hard time finding any market that has cash flowing properties that are affordable. So to save you hours, months, heck even years searching for the perfect rental property market, I'm going to dish out the top 3 market criteria that you need to know to find a successful, cash flowing, and affordable rental property market. Hey there, welcome back to Brick by Brick Wealth. My name is Casey Franchini, and I teach aspiring real estate investors how to be successful with their very first rental property. Investing in real estate is not cheap. Many of us work really hard for our first rental property down payment. I know I did. And I know you don't want to throw it all away on a bad investment, a property that sits vacant for months that nobody wants to rent, or even worse than that, buying a long-term rental property that loses you money each month instead of making you money. Buying real estate is a big deal. If you don't like it, you can't just return it to Target. You'll be stuck with all the problems you inherited. Buying your first rental property, especially when it's out of state, requires you take special precautions to ensure that you don't turn your asset into a liability instead. But you'll need to pay close attention to the data and understand what criteria makes a good rental market. And so today, I'm going to break down the top 3 criteria that me and my students use to narrow down the entire country into 3 profitable rental markets. And by using what I'm about to teach you today, you'll be able to cut at least half or even 75% of the country out of your rental property market search and save yourself tons of hours in the process. And if you stick around all the way to the end, I'm going to share with you the top 3 rental markets that I anticipate my students investing in 2025. But first, let me get a sip of my iced tea. 90% of my students are out-of-state real estate investors. And through proper research, we've been able to uncover some pretty gem real estate markets. Ones that are affordable, have quality tenants, and cash flow. There are 3 main criteria that I implement when narrowing down the entire country into 3 profitable rental markets. The first criteria is property taxes. This might sound straightforward, but there's actually more to it than you think. And when I was a brand new investor and bought my very first rental property, I actually screwed up with this rule. But I was lucky in that everything still worked out for me. First of all, some states actually charge more property tax for real estate investors than owner-occupants. And if you're only looking at their Realtor.com, Zillow, or Redfin, or Trulia property tax amount, you're definitely not getting the full picture. I invest in Memphis, Tennessee, and when I bought my first rental property, I looked at what Realtor.com said in the property tax section, and I factored that amount into my calculator when I was running my numbers. You can say I was pretty surprised when I got 2 property tax bills in the mail, and it was double than what I'd expected. I received 1 bill from the county and 1 bill from the city. Here's an insider tip, so listen close. Realtor.com only pulls property tax data from the county. So if the county and the city collect taxes separately, you're not going to see the city property tax data reflected in the Realtor.com calculator. Not knowing this cost me an extra $2,000 in property taxes I wasn't expecting my first year as a newbie rental property owner. Depending upon the kind of numbers that you're running for your rental properties, that junior mistake could cost you all or most of your cash flow and turn a good deal into a bad deal. But that's not all you need to know with property taxes. A lot of my new rental property investor students get super excited when they see the rental numbers on some property versus the purchase price in Texas. But unfortunately, it's really hard to cash flow in Texas, and it's because of the property taxes. See, the problem lies in how often the property values are reassessed, thereby you getting a new and usually higher property tax bill. In California, for example, and the one good thing about California is their property taxes really never go up after your first initial purchase. And that is how grandma is still able to live in her $4 million mansion in Malibu in a house that she bought for $70,000 in the 1970s. Because her annual property tax amount is about the same as when she first bought it. Now, if you're in a rapidly appreciating market like Texas, on the other hand, watch out. They reassess your property value every single year. And if the market is going up, so is your property tax bill. So if you buy a barely cash flowing property in Texas and it's rapidly appreciating, you might find yourself with a negative cash flowing property in just a few short years. So if you're trying to find a middle ground, you want to find a market that appreciates but also cash flows, consider states like Tennessee or Alabama. They tend to have lower property tax rates and are less aggressive with frequent property value reassessments. And these are the kind of markets that make long-term rental property ownership attractive. So when you're researching what market to invest in and you're considering property taxes, I want you to ask yourself these 3 questions. And if you have a pen and paper, now is a great time to take some notes. 1, are investment properties taxed at the same rate or a different rate than owner-occupied properties? 2, How often does the state reassess property values and send out a new property tax bill? 3, are there any caps on how much property taxes can increase in 1 year? And 4, and this is the big one, are you going to get separate property tax bills from the city and the county, or are they coming in one bill? The second must-have criteria for choosing a profitable and affordable and cash-flowing long-term rental property market is its landlord friendliness. Think about this. If you were to start a business, and it could be anywhere in the United States, and you had no affiliation with any city, and you were just blindly going to point on the map, would you want to choose a state that already hates you and doesn't really want your business? No. So unfortunately, that means not choosing a state that is tenant friendly. The shortcut here for this, and please don't bash me in the comments, but I wouldn't recommend choosing a blue state. And by blue, I mean Democratic. It isn't a hard and fast rule, and I'm not saying not to invest in blue states. I'm not saying it's a bad idea or you won't cash flow, because you definitely can, and I still have plenty of students who invest in blue states. I'm just saying to be aware of their landlord-tenant laws. Here's a couple of reasons why you might want to pay attention to whether the market you're about to invest in is landlord-friendly or tenant-friendly. For example, in California, they have the Ellis Act, which means if you want to get a tenant out of your property, you may have to pay them tens of thousands of dollars in relocation fees. It is not uncommon to have to pay your tenant $50,000 to get them to move out. In Massachusetts, you have to pay the tenants 5% interest on their security deposit every year. And in Seattle, they've enacted the first come, first serve law, which means you have to rent your property to the first person who passes your basic screening test. And in New Jersey, a victim of domestic violence might be able to live rent-free for several years under your lease agreement under the Safe Housing Act. Imagine placing a tenant and having to pay all the things, right? The mortgage, the home insurance, all of the repairs, the property taxes, any maintenance, but having a tenant living rent-free in your place because they're a victim of domestic violence. Now, does that make you want to run out and start buying rental properties in New Jersey if you have the whole country to choose from? Not me. When it comes to landlord-tenant rules, we're not talking about trying to rip people off and kick them out of their homes as fast as possible for no reason. We just want fairness. And landlord-friendly states make it easier to enforce lease agreements and regain possession of your property. This is critical for protecting your cash flow. In states like Florida and Georgia and Texas, the eviction process is relatively simple and goes pretty fast. Usually, from start to finish, everything can happen in 30 days if everything's done correctly. But then go compare that to states like California or New York, where it can take a year or more to get people out once they've broken the rules. So there's a few key things to make sure to pay attention to when evaluating whether a state is landlord-friendly or tenant-friendly. So again, if you have your pen or pencil, take it out and take some notes. 1, how long does it take to evict a non-paying tenant? Are the steps clear and easy to follow? 2, is there rent control? Is there restrictions on how much you can charge tenants and how often you can raise rents? And 3, how easy is it to enforce your terms of your lease agreement in court? 5 states stick out for me when thinking of the best states that have the most favorable landlord-tenant law. And the first one is Texas. They have a really clear eviction process and no statewide rent control. The second one is Florida because they have quick eviction timelines. The third one is Georgia. They have simple security deposit rules and easy to understand eviction rules. The fourth one is Indiana. Everything there is very straightforward. And Tennessee, where I'm at, they have strong property rights for landlords and investors. The eviction process is also easy to understand and clear for both parties. Choosing a landlord-friendly state is just as important, in my opinion, as choosing a property that cash flows. All right, now let's dive into the third must-have criteria for finding a profitable rental property market. This one really is a must-have. In my experience, now remember, I help newbies all day, every day, with their very first rental property. And again, 90% of my students are out-of-state investors, so we are researching markets all the time. I've been coaching for 5 years. I've been in the industry for 15 years. So what I'm about to say, I really mean it. At this point in time, you will need to find a market that has properties available for sale under $200,000. Now, this rule of thumb only applies to single-family properties. You're not going to only find cash flow in a fourplex that's under $200,000, even though it's residential. So only single families under $200,000, that's my rule of thumb. Haters come at me all the time on Instagram and on YouTube telling me that that's impossible. They say there aren't any good properties available for sale under $200,000. I live in California, you're a liar. And to that I say, I just had 3 students close on their very first rental property in different markets, and their properties were under $200,000, and one of them was even under $100,000. All their properties cash flowed, all were obviously affordable, and all were with 20 to 25% down. So there. Now, when I say me find a market that has properties available for sale under $200,000. I don't mean find a market that has 5 homes for sale. And I'm looking at you, Austin, Texas. If there are only like 5 properties for sale under $200,000, and there are a lot of properties in the area, those 5 properties are likely gutters and need a lot of work. And if they were fixed up at their rent-ready status, they would definitely be worth more than the $200,000. I'm talking about finding rental property markets where there are several hundred homes for sale under $200,000. Not every market is going to have houses for sale under $200,000. So you have to find the markets that do. My advice is to look for markets where the median home price is around $200,000. Under $200,000, even better. You can get this data easily all by yourself on Zillow, Realtor.com, or any nationwide MLS system. In Memphis, Tennessee, where I invest, the median home price last year was $189,000. It was a 13% increase over last year. One day, Memphis won't cash flow anymore, but today, it still does. Indianapolis, Indiana has great inventory, and it was a top contender for investment markets in 2020. But last year, their median home price was $250,000. It's just harder to cash flow there now. But if you had invested there a few years ago, like some of my students did, you'd have been really happy right now with your appreciation. Cleveland, Ohio has a ton of inventory under $200,000. Their median home price last year, $125,000. That's better than Memphis. And Memphis has been one of the top rental markets in the country for a long time. A lower median home price means more properties available that have the potential to cash flow that are rent ready and need minimal work to get them livable. Do you see where I'm going with this? Simple research can save you a lot of time. Cleveland's median home price went up 8.5% from last year. So one day, Cleveland won't cash flow anymore. Now, a property under $200,000 doesn't guarantee profitability. This is just one of the criteria that we use. You have to check the other metrics too. If you want the complete list of market criteria to analyze rental markets, you're going to want to grab my market criteria checklist. It's in the description below. But initially, if you're just now looking for your first rental property market and you're analyzing the entire country, you can narrow it down quickly by using the 3 criteria that I talked about today. Remember in the beginning, I told you if you stayed through the end, I would tell you the top 3 rental property markets that I think my students will be investing in 2025? Well, this is it. Since you stayed extra long, I'm going to give you 5 instead of 3 markets. The top investment markets in 2025, in my opinion, are going to be as follows. First one on the list is going to be Cleveland, Ohio, then Montgomery, Alabama, Akron, Ohio, Pittsburgh, Pennsylvania, and Memphis, Tennessee. Thank you so much for joining me today. If you found this video helpful, please do all the things, like, comment, subscribe, and ring the bell so you don't miss out on videos teaching you how to be a more successful real estate investor. I would love to hear your feedback on rental property markets, so chat with me in the comments below. And until next time, keep building your wealth brick by brick.